Hello, everyone. Welcome to the next of our TMA Now Network of Women webinars. This one celebrating International Women's Day. Our panel will be taking a look at navigating directors' duties in cross-border restructuring. But just a couple of things before we get started. Just your general housekeeping. I know you know the drill by now. And just give you a moment to have a quick look at the disclaimer. You can see we are recording this, so we will make a link available after the event. I just wanted to highlight a couple of key events for TMA Europe that are coming up. In just 2 weeks' time, we will be heading to Italy for this year's TMA Live, which follows the webinar a few weeks ago. And this year's program focuses on luxury retail and consumer goods. So we will be in Milan on Wednesday, the 19th, at a fabulous location, looking at 3 case studies. We'll send you the links for the details. And equally, if you can join us in Bergamo the following day, just an hour away on the train, EACTP have a day-long program, their 3rd year of turbocharged turnaround workshops. We'd love to see you. And one very important date for your diary, registration will open up next week for the 2025 International Symposium and Annual European, this year in Paris. There is a very good early bird discount available, and I just want to flag that with you. We will be sure to send you the details for that too next week. So with that, I'm going to hand over to Anna.
Yeah, welcome to our webinar. I'm Anna Nolan. I'm the chair of TMA Europe now. I'm also restructuring counsel at the US firm Alston & Bird, and I'm based in London. I'm excited that I can open this webinar on International Women's Day to celebrate it. And I will now hand over to each speaker to introduce themselves. Let's start with Ian, please.
Well, good afternoon, folks. My name's Ian Williams with Williams Consulting. I'm an English lawyer, admitted in 1989. I've worked in mostly international insolvency and restructuring matters throughout the 90s and the 2000s. I then went to work for an international firm of accountants and advisors in 2015, so I gave up my practice certificate, and then I formed Williams Consulting in 2019, since which time I've taken directorships of both English and Dutch and German companies that are in distress. So I've had experience of both being lawyer side and director side, and I'm looking forward to sharing my insights with you.
Hi everyone, my name is Kim de Bruin. I'm a senior associate at Loyens & Loeff, based in Amsterdam, the Netherlands. I'm very excited to speak to you today about fiduciary duties, and my focus will obviously be Dutch law.
Yes, and my name is Eva Ringelsbacher. I'm from Germany. I'm working for Dr. Wieselhuber and partner. I have a restructuring experience over 30 years now. And I'm the head of debt advisory at Wieselhuber and Partner. I'm also a board member of TMA Germany, and last year and this year I'm at TMA global level vice president for international relations, and I'm looking forward to our discussion today.
Thank you. Before we start, I have a couple of housekeeping points. I would like to encourage everyone to ask questions. And please use the chat function. Everyone is muted, so ask your questions through the chat function. And then at the end of our webinar, we'll also have some time to ask questions. So this webinar focuses on directors' duties in a cross-border context when a company becomes stressed, distressed. But actually, what does it really mean in each of your jurisdictions? When do the directors should become concerned about liquidity, about ability to pay debts, about creditors? I will start first with the UK and Ian.
So one of the things I find most interesting about this type of discussion, particularly when it's on a number of countries basis, is how things operate culturally and politically outside of the general laws in each country, because a lot of the ways in which the laws have developed in countries are based on culture, and Britain and Western Europe in particular were very and still remain in some people's eyes very creditor centric. So you will find that there's a distinction between what the Americans call the debtor-led culture and the recovery enterprise culture, and what existed in Europe. And a lot of that predicates how people respond, how directors respond to difficulties in their organizations. I mean, at its simplest, you will find that American directors, for example, are far more likely to seek advice earlier than British and European based directors, simply because the historic stigma of insolvency, bankruptcy, and debt is so much heightened on our side of the pond. You mean it's not that long ago in the UK that there were debtors' prisons. If you look at Little Dorrit, Charles Dickens's famous book that was based on his own family history, where his father ended up in the Marshalsea, which was a debtor's prison, you can see how society felt about debt. And I think you look at that now, you transpose that forward several hundred years, and you see that we, I think, have moved on more quickly than mainland Europe in our attitude to debt, and the way in which we look at debt. I mean, there was always this, back in the day in the 90s, there was always this famous analogy between golf clubs in the United Kingdom and in America. Basically, in America, if you filed for Chapter 11 and told your golf playing partners that you'd filed for Chapter 11, that was seen as something positive. Whereas in Britain, you were likely to be excluded from if you're coming into liquidation because of the stigma attached to that. And what we've seen is what we've seen in Europe, mainland Europe, is a real march towards replicating Chapter 11-esque jurisdictions. The Germans led the fray with that in the first amendment to the Insolvenzorg. They actually came up with a Chapter 11 type plan called an insolvence plan. But in the first 10 years of having that legislation, I think they did about 2 insolvence plans. Insolvence plan equals Chapter 11 plan. But culturally, the Germans weren't ready for it. And you see in Spain and France and Italy really advanced Chapter 11 type legislation, which was predicated on the back of the American wall of money in the 90s. But of course, that didn't change the culture. It just put more money into Europe. We, of course, standing inside but outside the European Union, our laws kind of modified themselves, and there was this issue of us having a Chapter 11 thing, but it never quite got done by Tony Blair. But just going, that all what I've just said behind as a preface to Anna's question means that the earlier that you get, that the directors get to advice, the better. And that doesn't happen so much over here because of this. Even now in the 21st century, there's still a reticence. Whereas in the US, there is this culture that predicates payment for advisors, and Chapter 11. I mean, Donald Trump knows more about US bankruptcy law than I do, because he's used it throughout his business career. And many of the big entrepreneurs in America have positively used Chapter 11 to get themselves out of it. So I think in stopping there as the first part of my answer, the earlier that directors take advice, the better, because it gives them more chance then than when the creditors are kicking the door down. So the first sign in the UK, for example, is creditor pressure, breach of banking covenants, that kind of thing. Get in as early as you can, get some proper advice, and get it recorded gives you the best form of protection.
Yes, so in the US, the directors are protected by the business judgment rule. Now I would like to focus more on the duties of the directors and some extra considerations they need to be aware of when the business is becoming insolvent. It could be balance sheet insolvent or cash flow insolvent. I know that this is quite actually a term open to interpretation and is also interpreted differently in each jurisdiction. So maybe let's move to Germany. Eva, that jurisdiction is quite scary for a director who is part of an international group. There are some filing obligations. Can I tell us more about it?
Yes, there are filing obligations. We always say the clock is ticking. 3 weeks after you see that you are running into illiquidity, you have only 3 weeks time to apply for and to file for an insolvency. The problem we see, Ian, you mentioned it, it's still a stigma. Please never say in a turnaround restructuring case the word insolvency in German. So nobody would like to hear it. Yes, we have our insolvency plan, which was the idea to adapt Chapter 11 in Germany. For many years, people didn't want to go this way. Now it's quite common. We have also the so-called Staruk, which is an out-of-court restructuring possibility. And we see some cases now with the Staruk. But in the end, even in the law we call Staruk, it's definitely a problem with the fiduciary duties. So we have not this business judgment rule. And it was a huge discussion if we really want to introduce this into this new law for some years ago. And we are now on the point that we say we must do an evaluation of this new rule. And we think the most important point is to find a way to skip these duties for the directors, because it changes in one point of time that they are not looking for the duties with respect to the shareholders. It changes to look at the duties with respect to the creditors. And this is a crucial point for directors to say where are we standing here. And the law also have an implementation and says you need an early warning system. Every company has to install an early warning system. But by the way, when I see our clients, first meeting with our clients, they often have not this early warning system. Even they have not a liquidity planning, a liquidity forecast. And when you ask them for this typical 13-week cash flow forecast, in the last maybe 15, 20 years, I saw only one company which has already implemented such a forecast. So this is a crucial point.
Yeah, maybe this is a nice point to discuss to make a Dutch comparison, because there are some similarities, but I think the main difference is that we do not have a filing obligation in the Netherlands. So in the Netherlands, you do not have a balance sheet test. You can simply act going concern until you foresee that you are not able to fulfill your payments as they fall due. So the focus in the Netherlands is more on the liquidity position rather than on the balance sheet. And again, no filing obligation in the Netherlands. But what is similar to Germany, as I just understood from Eva, is that if the board of a Dutch entity foresees that it is, or that it will become unable to fulfill its payments as they fall due, the interest that the board should take into account focus more on the interest of the creditors and the recourse that they can take on the assets of the company, whereas outside an insolvency zone, or if there's no insolvency at all, the interest of the entity as a whole and all its stakeholders prevail. Whereas if there is a financial distress, the board should attract more importance on the interest of the creditors. So I think that's quite similar to Germany. And I totally agree with Ian. It's always advisable to get advisors as soon as possible, not only legal advisors, but also financial advisors for valuation purposes, potentially distressed M&A or refinancing purposes. But again, as we do not have a trigger moment in the Netherlands, we sometimes see that board directors tend to engage advisors too late.
But just remember though, I think I've stressed what sets us apart, particularly from the Americans. But remember, what brings us and the Americans together is the underlying law. I mean, obviously the Romans never got to America. We took them on our battleships, but remember the underlying concepts of directors' duties and laws come from Roman law. I mean, you have this whole concept of actio Pauliana, Pauline transactions, which are effectively, preserving the insolvency estate, and duties flow from the fact that insolvency is a class action. So there should be nothing that depletes the insolvency estate through transactions that undervalue gifts or preferences. And this concept of having duties to a company is founded in Roman law, and that pervades German law, Dutch law, Spanish law, Italian law in particular. So there is this certainty. So if you are a director that's waltzing around the continent like I am, you still know that those same legal concepts in the broadest sense, because remember the civil law, Germany and Holland and France, they have civil law jurisdictions which are more rigid than our statutory plus common law positions, but essentially the concepts are the same. So if you are a director or planning on becoming a director, at least you can take that knowledge with you, because you then know that you then know the key things to avoid, of course nuanced by the particular area in the particular country that you're in.
Yeah, and in the UK, case law is very important. So, for example, Sequana is an important case which confirmed that the creditor duty exists, and also what's important is that it confirmed when the creditor duty is engaged, because everyone wanted to know, okay, it exists, but when it actually becomes engaged. So in Sequana, the court said that it is engaged when the directors know or ought to know when the company is insolvent or bordering on insolvency, or that an insolvent liquidation or administration is probable. So the knowledge of the director here was quite important. And for example, Ian, you're a lawyer, you're also a director. So it is actually, each director is especially in the UK, is subject to some sort of reasonable standards. There is some reasonable expectation as to the knowledge of a director. But certain directors, if they have enhanced knowledge, because, for example, they're lawyers, or maybe they have some financial experience, they might be held up to higher standards. And how did it play out, Ian, in your cases? Have you ever had to think about some additional considerations due to your background?
Oh yes, absolutely. Because I've been doing this for a long time, so I don't have a stupid excuse. Even though I might be, because it's a different skill set being an advisor to being a director. Directors generally tend to be entrepreneurs. I've just fallen into being a director because of certain things I won't necessarily bother you with, but I've taken on a number of UK companies, 2 of which have ended up in insolvency. So there will be 2 reports in respect of my conduct to the relevant authorities. So far I've not been disqualified, but then I was there for a particular purpose. But you're right, you do have to be particularly careful if you are a professional director, because you are going to get a higher standard. You're not going to be able to stand there in front of a judge and say you didn't know the company was insolvent, or you didn't know the laws on wrongful trading or fiduciary duties. So you're going to get the book thrown at you, and therefore you have to be aware of protecting yourself, both in terms of your own role, in terms of insurance, indemnities, that kind of stuff, which we might come on to later, and depending on when you want to deal with that. But it does make a difference if you're not Joe Public. Joe Public, who's an entrepreneur, will get away with a hell of a lot more than I will. if things go wrong. So I am acutely aware of those considerations when I do take directorship, and particularly, of course, in like my Dutch directorships and my German directorships. I am a director of a company that filed for insolvency, and I have had a bit of a run-in with the Insolvenzverwalter, or the insolvency administrator, because certain payments were paid away without my knowledge at the particular time. So I've had to pay those back. So there are things that can go wrong, irrespective of your best endeavors. But I am concerned as an overseas director of Dutch and German companies, because I've had friends of mine who've done this job, that because you are not from Holland or Germany, and you are from the UK or America, they believe that you will automatically have buckets full of D&O cover, which you need to know this if you're planning on doing this yourselves. Anybody's listening, D&O cover is almost impossible to get for German directorships unless you live in Germany, or for Dutch directorships unless you live in Holland. There are very few underwriters. I've been to underwriters in the United Kingdom who wanted £100,000 minimum premium for about £2 million of cover. So that is how these jurisdictions are regarded. So all these things you have to put into the risk profile. The difference between risk profile of people in big firms and people like me who work on my own, I can pretty much decide whether it's risky or not. But you'll find that if you're in big firms of accountants or lawyers, you probably wouldn't be allowed to take the appointments, because it is seen as too risky, when it really, you have to kind of, you have to try to strip away your lawyer's hat sometimes and say, look, I've got to do this job. I've got to build this building. I've got to sell these 2 Dutch buildings. What really is the risk profile? Sell the building, pay off all the creditors, dissolve the company. That's what I've done in Holland twice now. And, touch wood on International Women's Day, that I'm not going to get buried by a load of Dutch creditors, but there aren't a load of Dutch creditors. But, there are. Dutch law is quite tough too. I mean, there's tortious liability for directors. So, but again, you use people, we used Kim's firm on one of the sales. We use proper people. We take notice of what they say. My own German lawyer, just to kind of rub salt in the wounds, wrote an article called "Dance on the Volcano: Steering a German Corporation Through Crisis." I said, what the hell is this all about? Dancing on a volcano? Is it really that? Is it really that bad? But what he's right about, and I think Ava might have a point on this, is that even mainstream German directors, I don't think, understand their own law on this, because it is pretty damn tough.
Yes, this is, I think before we come to discuss about the D&O insurance, the most important point for me is that the directors are aware of what happened there, because we have a personal liability, and we have also the problem maybe with a criminal liability. And important is for directors and also for de facto directors that they are in a liability here, and that they have to look very clear if they have an early warning system building up, if they have a proper reporting, if they have a liquidity planning, which shows them if they run into an issue or not. This is for me the most important points, to be well prepared if you go in such a situation. And yes, with respect to insolvency law, I often see it that there is still hope. Many directors hope, even if the company is their own company, they hope that everything went well. And it's very difficult to explain them, please go to a lawyer, which is an expert for insolvency law, hear what the lawyer tells you, and we can provide you with all the reportings and the liquidity planning. And by the way, also, if you see there's a problem with the liquidity, to give some advice, like, is there a possibility having a new shareholder loan? Could we maybe go for a bridge loan by your lenders? what are the countermeasures, cost saving, cost reduction measures, that they feel comfortable to go forward. And you maybe know we have this another speciality in restructuring, which we call restructuring opinion, where we say in the end, yes, this is a going concern matter. And then they are quite sure and on the safe side. But they must go this way, knowing where are the problems and have the right advisors on board.
So in a cross-border context, how do the directors make decisions as to the available options? Because at some stage the directors need to assess what the options are. It could be rescue financing, can be M&A, or can be a restructuring plan or Dutch plan or a UK restructuring plan in another jurisdiction. So how do the directors actually decide that maybe the company should move to the UK and do a restructuring in the UK rather than going ahead with the options available in the Netherlands or options available in Germany?
Well, this is the
So
forum
for example, in
shopping.
the Netherlands,
No, I'm sorry.
yeah. For example, in the Netherlands, if the board comes to us and said we have financial difficulties, please assist us, we normally tend to look at what is the problem here. Is it that there is too much debt on the balance sheet that you want to restructure? Then we can look indeed at restructuring procedures such as the Dutch WOA or, for example, a UKRP if the debt is governed by English law, for example. But if it appears that it's not so much a debt problem, but rather an operational problem, we would normally advise to engage with a financial advisor as well to try to get to a distressed M&A deal or a normal M&A deal, or to ultimately file for insolvency with the hope that a restart can be effectuated after insolvency. So from a Dutch law perspective, it is very important to look at what is the problem. I think that will be relevant for all the jurisdictions, and that all options are considered. And what we always advise, and it's rather practical than legal, but that we always advise to document the relevant considerations that the board makes. Is the board still acting in the interest of all its creditors, evaluating all the options available, potentially substantiate all the options with valuation reports to the extent possible, so that they can show, if it ever comes to a proceeding, that they can show that they investigated all the options and that the option they chose is in fact the best option on the table.
I think this is a very important point, saying documentation.
Yeah.
That you have a documentation which shows the director, is there a going concern and a turnaround could be done? Is a way out of court restructuring or in court restructuring? Or for example, in Germany, we sometimes look to the Netherlands saying, could we maybe use the WOA? From our perspective, this has a big advantage. You can cancel bilateral contracts, which is not possible under our Starhook. And even we look at UK. I remember many years ago, it was a scheme of arrangement for Rodenstock, and Rodenstock was really a pure German company. So this was an effective way to restructure the company. It was a financial restructuring. And
yeah, maybe to promote the WOA a little bit more.
Yes, please.
You can already
so much about WOAs.
but you can even start a WOA if there is sufficient connection with the Netherlands.
Yes.
So it's not required that the entity is located in the Netherlands, but if there is, for example, a group entity that is in the Netherlands, or if the debt is governed by Dutch law, you already have sufficient connection to start a WOA.
I mean, I think this is where we get into the kind of slightly controversial type, the concepts of comey shifting and forum shopping, because you know the big thing at the moment is which is going to be the first major American company to file a 15 outside the file outside the US and import on a 15 rather than using 11. And this has been widely trumpeted around the place. This was this was at the time pre-Trump. I mean, it would probably be regarded as un-American now to do that. But there was always this issue of Comey shopping, and we came across this years and years ago with people jumping out of mainstream Europe into the UK for all the reasons I mentioned in my first remarks, related to culture, related to rigidity. But of course, now it's becoming even more interesting due to Brexit. And of course, the mighty Dutch have come up with their WOA, and the Irish are banging on about their scheme of arrangement. This makes it a whole heap more competitive to challenge the historic and robust scheme of arrangement as to where would you go. Look, the Dutch and the Irish schemes and the WOHA are very innovative in the way in which they go about the scheme, less so because it's just a derivation of the English scheme. Then we've got restructuring plans, and then of course you turn round to the famous Gibbs rule, and what do you do about that? This is about discharging English law debt under a foreign insolvency, and that goes back hundreds of years. In fact, I'm currently researching the Gibbs papers because I was intrigued about this concept of a French insolvency back in that time, trying to discharge or seeking to discharge an English debt. There was a time when I was prepared to concede the Gibbs rule in the years when I was pre-Brexit, but I think Brexit put a whole new dynamic on things, and those of us who are not terribly happy about Brexit have to kind of button down and say, well, look, whilst we went to all the trouble and many UK professionals got involved in the European regulation, I think there's not much chance of the government relenting on the Brexit, on the Gibbs decision, although it was proposed at one time, but the Insolvency Service kicked it back. So forum shopping is still out there. There are now alternatives to filing in London. You will still see considerable filings in London, I think, for the foreseeable future, because a lot of debt is written under English law. And that kind of predicates it that the Dutch and Irish markets are quite small, but you'll find the Irish in particular have done very well out of Brexit. So yes, it's all up there. It's all up there for grabs.
Actually, we've got a question from the audience. It's about the director's duties to file for insolvency, and it's for Eva and for Kim. So, are directors' duties to file for insolvency in the Netherlands and Germany satisfied by commencing a proceeding in another jurisdiction? So, for example, are they satisfied if we commence a restructuring plan in the UK?
So maybe to start from a Dutch law perspective, because the answer is shorter than Eva's answer, I assume. But because in Netherlands, we do not have a filing obligation. So there's no requirement for the board to file for an insolvency procedure. Instead, if it foresees that it's unable to fulfill its payments as they fall due, it can in fact decide what option is the best on the table to offer a solution for the problem. That could either be an insolvency, a WOA, a Dutch suspension of payments, but could indeed also be an UK RP or any other procedure. So no filing obligation in Netherlands.
We have this filing obligation if the German company runs into a illiquidity situation. In between 3 weeks, you have to file. I'm not quite sure if you can say or argue we file in another jurisdiction and therefore we need not to file in Germany. I'm not sure about this. But for example, last year I saw a case. It was a German company, and also they have a production site in East Europe, in Poland. And nevertheless, they file for both in the first instinct. They file in Poland for the Polish company and in Germany for the German company. And then there was another filing in Germany for the Polish company to ensure to bring the whole insolvency case to Germany and have only one administrator, and this was working. In the moment where the German court opens up the insolvency, also about this company in Poland, then we close the file in Poland. But this was, it's not the question here, I understand it, but this is an example how it could work. So I'm not sure if you can argue you file in another country and this is enough to say, I have not to file in Germany too.
And must it be, Eva, must it be an insolvency procedure that is, for example, listed on Annex A of the insolvency regulation?
Officially, there is not someone listed at our courts. Unofficially, yes, some lawyers. So this is maybe also different to UK, for example. Our insolvency administrators are mostly lawyers. And every court every insolvency court has some kind of lists of insolvency administrator. The most important point is that you find the right administrator who knows maybe the industry of this company and the size of the company is very crucial. Is it a small company? Is it a big company? Is a company who is doing, for example, business globally? And the court has to decide which lawyer will be the administrator. It's a little bit easier, for example, when you go now, because we call it a creditors meeting, and the creditors can make a proposal which insolvency administrator should be installed. And then if there are not really big issues with this person, the court has to open up the insolvency with this administrator.
I wonder if it would be possible to open, if the German company's center of main interest wasn't actually in Germany, whether you could open a primary proceeding in the country where it was, where the center of main interest was, and then have a secondary proceeding in Germany. I mean, that might go some way to ameliorating the damage done. But I mean, they shifted Schaffenacker offshore, if you remember, all those years ago. Shifting companies out. That clause, I remember, you remember as well, Ava, because I know you were around at the same time when there were all those Comey shifts out of Germany. That didn't do much good for relations between the English and German insolvency practitioners. There were some quite heated exchanges at conferences during those years, if I remember rightly. Particularly when they moved Enron Spain out of Spain into the UK, that caused some trouble. But I think in terms of the answer to the question, I wondered whether that might ameliorate the risk to the directors if of course the center of main interest wasn't in Germany, and there could then be a secondary proceeding.
And I can tell you it costs a lot of money to make this Comey shift. And in my personal opinion, it's always better not to use the Comey shift. So what is really a good type of doing restructuring is, for example, when you have this sufficient connection, for example, to UK law. And we have this quite often in Germany, because if you have a LMA standard loan documentation, it's under UK law. So this is a point where you can say we could do it a little bit more easily under UK law, but a Comey shift is really expensive.
Yeah, I mean, well, there's good forum shopping and bad forum shopping, isn't there? That's like everything. There's a forum shift for definitive positive reasons, and there's a forum shift to avoid creditors. But back in the day, not much of that was. I remember particularly the American firms didn't like the idea of doing proceedings outside of the UK, so they would just file in the UK. And take the risk that someone would challenge it, and of course nobody did half the time. So we've come on a long way from those times, particularly with the the way in which the EU regulation has developed, but I suspect it's still an issue, although there are now these alternatives in for example, Holland and Ireland for people to go to.
Yeah, and now coming back to the Minefield issue here and to liability points. So actually, if a director decides to trade and the company is insolvent, the director did not instruct specialist restructuring counsel, perhaps deepen the insolvency by borrowing more money and taking on extra creditors, what would be the liability? Is there any personal liability in your jurisdiction, criminal liability?
There is, yeah, there is, and this was one of the great reforms of the Insolvency Act in 1986. The idea because back in the day, insolvency was a little bit flexible in that some people would just simply sell all the assets and keep it in fees, and the directors would walk, and there'd be multiple companies, repeated failures, and the public were getting fed up with it. And there was this big consultation, and they came up with these concepts of fraudulent and wrongful trading. Obviously, fraudulent having an intent, but wrongful trading being willful blindness, Nelsonian blindness as to that your duties could result in wrongful trading. And they put a disqualification regime in place. Now, interesting to note that the Dutch actually have a disqualification regime as well. I'm not sure whether the Germans do, but we have this disqualification regime and have had since 1986. I've never been a fan of it. I've never been a fan of the disqualification regime. The wrongful trading and the fraudulent trading regimes are not much used in the 30 odd years that I've been doing this. I can't remember that many wrongful trading cases, but lots of directors have been disqualified, which is okay, fine, they're disqualified. The problem is that the infrastructure isn't there to police the disqualifications. Becoming involved in the management of a company after disqualification is a criminal offence, but there just aren't the resources to police that. So I've always thought it put insolvency practitioners, and I can see my good friend Mr. Cortman on there, filling in these reports, and then when one of their clients gets one of the people gets reported and is going to be disqualified, they have to put a lot of effort into affidavits and support in the transaction. And at the end of the day, it's not a big deal being disqualified, because people change their names, nobody follows up on what they're doing, and unless somebody actually reports them, the sanction is actually rather toothless. That being said, breach of fiduciary duty actions and wrongful trading actions are useful and can be used to put pressure on directors personally, particularly directors. There are extensive powers of investigation under our laws. I mean, you can summon people to court and have them examined. You can make them give affidavits. So there are investigatory tools which are quite draconian in their use. So yeah, there is a structure of deterrence in English law ever since. It's not quite as draconian as going to prison, but there are directors who go to prison. The criminal side of things and the interaction between the criminal side of things and the civil law side of things is quite interesting. I've done that quite a lot in my overseas fraud cases when the feds get involved, and there's often a bit of a clash between us and the feds, because obviously the difference between us and the feds is that they have to prove beyond a reasonable doubt that it was a fraud. We have to show on the balance of probabilities there was a fraud, which is a lower test. So sometimes we come to an agreement with the feds, and I shouldn't really call them the feds, but the feds, that they should use us to do the job, because it's going to be easier for us to get the money out of them and get a finding of civil fraud against them, which might help them get a finding of criminal fraud against them. But there's often tension between liquidators and administrators and the public authorities as to what should be done. But yes, they're not as effective. I have to say, the SEC in the United States is a hell of a lot better at this than we are, I think, in my humble opinion. We tend to get clogged up, but the SEC are just merciless. You just stand back and let them kick the door down, basically. But we've had some significant failures in the public authorities prosecuting insolvency-based fraud.
And maybe from a Dutch law perspective, we have a lot of some sort of director liability options. So the first one is more of internal nature, so that the director can be held liable against the company. The others are more from external nature. So for example, the board can be held liable by the bankruptcy trustee in an insolvency, can be held liable for the tax, debts, and premiums of social security liabilities. Wrongful distribution of profits can be a ground for director liability, and of course criminal liability. But I think the most important for this webinar is the wrongful trading liability on the basis of tort, and that entails in fact that the director should refrain from entering into new contracts while it foresees that it will be unable to fulfill the obligations under that contract, and to ensure that the creditor can take recourse on assets of the company. So again, the director should refrain from entering into contracts while it foresees that it is not able to comply with the obligations thereon. I think that's the most important director liability that should be mentioned in light of fiduciary duties at this stage. And then we also have the liability on the basis of tort with regard to selective payments, but also that is a very high threshold in the Netherlands, because as a director, you have a large degree of freedom to decide who you will pay. So you can pay director A and decide not, for creditor A, and decide not to pay for creditor B, unless you have decided that the company will be liquidated. Then you can no longer make selective payments to, in short, related entities or related parties without there being a reasonable argument to do that. So those are the two main important items for directors to take into account in the light, or if they foresee that they will face financial difficulties.
It's more or less the same in Germany. The most crucial point is not to go in any obligations when in this point it is crystal clear that he cannot pay, that he have not enough cash liquidity in the company to fulfill this obligation. And the second one is never do any selected payments. So don't, you should not as a director try to pay, for example, the banks back, but you pay not your suppliers, for example. So these are the two crucial points in Germany too.
Yeah, so we're closely running out of time, but I would just maybe summarize where we are. It was a very interesting discussion. As we see, each country has a different insolvency framework. There are very different considerations for the directors and different risk profile. So it is really important to talk to the lawyers, especially if there is a group, international group with a number of subsidiaries, and there is the same director is appointed in relation to all of them, because at the end of the day, the director owes duties to each individual company, and it needs to consider such duties in relation to that particular individual company. But I have a quick question just to close this discussion for each of you. What do you think about a resignation as a mitigation strategy? If a director thinks, no, this is not going in the right direction, I just want to resign. Would you recommend resignation in your jurisdiction?
Well, it would not help from a Dutch law perspective. Resignation does not protect a director under Dutch law. What could protect a director is that if it resigns, that the company gives discharge to the director. So that is possible under Dutch law. So the company would discharge the director for any future liabilities. And we also see that at the end of a book year, that the board will be discharged for any liabilities during the past book year. So that is what we see, but resignation on a Dutch law would not help a director from being held liable.
It's the same in Germany, so resignation helps not. You are still liable.
I think that the same is true. What you can do though is slightly nuanced, particularly if there's a board and you are kind of a dissenting person. If you set out your reasons in a carefully worded letter, it doesn't absolve you from actions as such, but that you then resign, showing that you don't wish to participate in whatever positive or negative actions the board takes. But provided you must note your decision very carefully and make sure that is widely known to the company and its stakeholders.
Okay, thank you, everyone. Even anyone else has questions, you're welcome to ask them now via the chat function. We'll give you a couple of minutes, and depending on if there are questions or if there are no questions, there is another part which is networking. If you have time, you're welcome to stay with us. We'll have a couple of networking spaces where we can talk to our speakers and ask questions.
Thanks very much, Anna. Thank you very much to our panelists and to you all for joining us today. We have got 3 breakout rooms set up.